It's only natural for investors to look for a connection between who wins the White House and what way the stock market might go as a result, especially when the US makes up such a large part of our investment portfolios. But do the markets really care about who sits in the White House? You might be surprised to hear, not as much as you might think. In this video, I'll explain why elections don't affect your investments the way you might expect, and why keeping a long-term view is crucial. I'll go through some real-world examples, and stick around until the end because I also have some really interesting historical data to share from the research team at Dimensional that really puts things in perspective. First, let's talk about the short-term versus the long-term, and make sure we're not blurring the line between the two. Yes, it's true that elections can cause short-term volatility. Markets might jump up or dip down when the results come in, or even in the days and weeks around the elections. But here's the key. Markets are driven by much more than just politics. So take a step back and think about it. What actually drives long-term returns? It's things like company balance sheets, corporate earnings, innovation, and business growth. Remember, we as investors are shareholders in real companies, and these companies care about looking after their customers and growing their businesses. And that doesn't change depending on who's in the White House. Meanwhile, political events are not anchored in any way to company fundamentals. So although they might create some short-term chatter, they have very little real long-term impact on the stock market. A great example of this is the Trump election back in November 2016. I was actually in New York at the time of that election, so I had a front row ticket to the sense of chaos. And I remember people panicking and setting out of the market to wait for things to settle down. But when did those people put their money back into the market? For how long did they sit around in cash, sitting on the sidelines while inflation eroded the value of their hard-earned life savings? Well, here's how global stock markets did over Trump's presidency. And this red dot here is the day he won the election. Sure, there was a little volatility around the time of the election, but it doesn't look like much when you zoom out, does it? And look what markets did after that. Even on the darkest hour of the darkest day, at the absolute bottom of the market during COVID, the stock market was still higher than it was on the date Trump was elected. So there's a very good lesson here. Election years may see some bumps, but over the long term, we all know that markets tend to rise. So should you be making changes to your portfolio every 4 years when US elections come around? Absolutely not. Let's dive a little deeper into the data and look at this chart from Dimensional. This chart tracks the performance of US stocks during various presidential terms going all the way back to 1926. The red periods are when a Republican was president, while the blue periods represent a Democrat. And here's what it shows. Markets have gone up regardless of whether a Democrat or a Republican was in office. Bull markets have appeared under both parties. Bear markets have appeared under both parties. Markets simply do not care who is in office. So that's the lesson here. There's no clear correlation between which party is in power and the direction of the stock market. So whether it's a blue or a red White House, the stock market continues to do what it has always done. Trundle relentlessly on, punish short-term speculators, and reward long-term investors. Now, it's tempting to react to election news by making quick moves in your portfolio, but doing that will probably hurt you more than help you. Think about it. If you jump in and out of the market every time there's an election, you're interrupting the power of compounding, and you're not giving your investments the chance to grow and snowball over time. To illustrate this, let's go back to the Trump election example from earlier. Imagine you are one of those people who pulled your money out of the market on the day Trump won, to wait for markets to settle down. For every $100,000 invested, here's what that would be worth today, depending on how long you stayed on the sidelines for before putting your money back into the market. If you'd waited just 1 month, you would have $232,000 today. If you'd waited 3 months, you'd have $225,000 today. If you'd waited 6 months, you'd have $212,000. If you'd waited an entire year, you'd have $193,000 today. But if you'd simply stayed invested the entire time, you'd have $240,000 in your portfolio today. I'm sure you notice the trend here. Time in the market is probably the single most important contributor to your wealth creation. So missing just a few of the best days because you sold after an election or for any other reason can significantly lower the returns that you achieve. Remember, stock markets do not lose money. People do. Research consistently shows that timing the market is nearly impossible, yet so many people try. The best strategy is to simply stay in your seat and stay the course. Keep your long-term goals in mind and stay invested, no matter what's happening in the political arena. Don't let the noise of US elections, or any other elections for that matter, influence your investment decisions. Who will win the election, or what does that mean for my portfolio, are both the wrong questions to be asking yourself. So what should you be asking yourself instead? Well, the same questions you should be constantly asking yourself, reviewing and refreshing all the time. What are your goals and objectives? What are your timelines? By when do you actually need to reach those goals? How much risk are you comfortable with? Do you have your investments and your asset allocation aligned with all of that? Or are you out of sync and pulling in different directions? Are you keeping control of the things that cause a drag on your returns, like costs or taxes? Speaking of taxes, are you investing in a tax-efficient way? Are you budgeting, saving, and doing all of the day-to-day things right? And perhaps most importantly, are you focusing on the right goals? The term financial goals is often used, but in reality, financial goals don't exist on their own. Goals are about enhancing your life, and money is just a tool to help you achieve them. So don't get too attached to arbitrary financial targets that aren't tied to real-life aspirations. For example, having a $2 million portfolio is not a goal. It's just a number that sounds nice. It might be right for you, or it might not. Retiring, on the other hand, is a goal, and you might need a $2 million portfolio to support that, or you might need less, or you might need more. What's important is to dig deeper into your true goals and understand the why behind your financial decisions. When you do this, you can then coordinate your finances properly and be intentional with your financial decisions. And then you'll probably realize that short-term market movements, like what happens to your portfolio over a random 2-week period in November, has no impact on your long-term goals like retiring, buying your dream car, spending 2 months a year in Spain, or sending your children to university. So instead of focusing on elections, focus on the things you can control. Invest with purpose, remind yourself of that purpose, maintain a globally diversified portfolio, and stay disciplined. By staying diversified and thinking long-term, you'll give yourself the best possible chance of success, no matter who's in the White House. The US elections will come and go, but hopefully, you're going to be here for the long haul. Therefore, your financial goals and your underpinning investment strategy are also going to be here for the long haul. So don't let short-term events derail your long-term plans. Thanks for watching, and if you found this video helpful, don't forget to like and subscribe for more tips on navigating the world of personal finance and investing as an expat. For now, stay focused, stay invested, and see you soon.